I'll give you the big stat right off the blocks here. When January is up 40 out of 45 times since 1950, the year is up. That's an 88.9% bat, or an 889 batting average.
Yeah.
And it's an S&P average is 17% per year. When January is up, only down 5 times in the 45 instances since 1950. So then there's this old first 5 days. On this tables here, it's FFD, Santa Claus Rally, obviously SCR, JB, not James Bond, but January Barometer. And FFD is the first 5 days. It's an early warning system. It's not the first week of the year. It's the first 5 trading days, which can overlap more than 1 week. You know, the calendar's a little tricky. But what we did, what my partner Christopher Mistel and I did back in 2013, when Yale was still with us, we looking at this combination, and there's a page in the Almanac. I think it's page 18 or 20. It's 20, where we stood on Yale's shoulders. We took all 3 of these indicators and put them together. When all 3 are up, when you hit the trifecta, that's where the name comes from. The S&P is up 90.6% of the time, even a little bit more than just the January Barometer itself. Only down 3 times in 32 years, for an average gain of 17.7%. We didn't hit the trifecta this year, but the situation that we had now is we had a very small data set. That's why I kind of mentioned the full month January Barometer. 40 out of 45 is a pretty solid statistical data set there. But here we had, this is only the 4th time in the history since 50 that we've had a first 5 Santa Claus Rally down, first 5 days up, and a January Barometer up. Pretty solid history. I know it's small, but it's really all about the January Barometer to me, and it enabled me to reaffirm my annual forecast, which was initially written about it back in June when we put out the Almanac that you have there in your copy in my Outlook. But we also put out our newsletter forecast, to our subscribers just before Christmas, the Thursday before the holiday. And then we wait until we get trifecta results, which we just had at the end of January. And we're still looking at an annual forecast of 8 to 12%, which is our base case scenario. And I think when you and I discussed I'm just pulling up the chart on my side. When we discuss the post-election year seasonal pattern, you'll see where I get that 8 to 12 percent change.
Now, a lot of folks might be saying, well, gosh, we've had 2 really strong years, back to back on the S&P 500. How often can it do it again? 8 to 12 is, it's not 20 plus, but it's no slouch.
It's kind of an average, market gain. It's in the historical average, which I think speaks in and of itself that it's pretty much a standard year. We've also seen post-election years much better since World War II. I know there's an old saying going back to past Grover Cleveland and even to Andrew Jackson's time with some of the old Cowles indices stuff that we have data on, where the post-election year used to be bad. It has been worse for Republicans because they tend to come in like current president is doing to try to take care of things early. But overall, post-election years like 2017, Trump's first post-election year, a lot better. And the best of the 4-year cycle since 85, up 17.2%. You go to the next chart there, and since 85, it's been much better. 8 up and 2 down. The 3rd year is still great, a little bit lower average, but up 9 years out of the last 10 post-election years. But this is something that we got to keep an eye on here. We've actually just updated this version for our members earlier today. But everyone knows that we've gone a little bit into February. We've been chopped into the little gold, yellow line there is 05. So the red line we're going to sort of put that in the background for now, but it's something we're tracking and we got to keep an eye on. That's the incumbent party loss trend. We're not tracking it now. We did a little bit out of the blocks when we were some selling in January, but that's sort of what happens after we have a change in administration, change in party in the White House. The other lines, the other groupings are all post-election years since 1949, first full cycle after World War II. Incumbent party wins in green. The pink year is the 5th year of a presidency. I know we had that Grover Cleveland situation again, but it's still the 5th year of a president. He's not going to have more after more years after his term. And then there's the aggregate cycle, the composite, whatever you want to call it. It's all years since 1949, post-election years, and 5th years of the decade all combined. And if you go over to the right side, you'll see the 8 to 12 kind of just right there. And as long as we keep tracking, I'm pretty comfortable with, we also call for some first quarter chop. It's one of the weak spots of the 4-year cycle, as well as the weak summer months, the August, September. You can see all of the different groupings there have some weakness in that, worst 6 months. People call it the sell in May period. Well, guess what? It's not sell in May. It's reposition in May. We've got some rally. We're seeing that mid-July peak a lot these days, which we had last year. But basically, this is the foundation of the forecast and outlook. We had confirmation from January, and we're tracking. We've come back. The updated chart I have shows we're kind of really coming right back in here to where the pink and blue and the green lines are conjoining there in February. So we're really, sort of reverted to the mean here, and it's just uncanny how we're tracking this pattern again.